All right, thank you, everybody. Welcome to our February 28th, 2011 FXDD co-production with FXStreet.com. This should be a really good one. Now, to give you our disclaimer, we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. Okay, we've got a special one for you today. It's called Using Moving Averages in Your Forex Trading. I think you're going to find real benefit from this and really enjoy yourself. Okay, here's Greg Michalowski. He's the Chief Currency and Trading Analyst at the company at FXDD. Many of you know him from his presentations on FXStreet or on our commentary pages at FXDD, forex.fxdd.com. Myself, I'm Sean Powell. I'm on the right there. I'll be helping along in the chat window as we go through the training. I think you're going to find great enjoyment out of it. Now, just to give a quick plug for FXDD, if you do want to open a trading account, I can get you a special bonus of an extra $100 in a new account. What you need to do is just send me an email. It's spowell@fxdd.com. You can go through this link to open your account. It's fxdd.com/FXStreet. All right, so with that being said, I'm going to pass the microphone.
You all coming out here today, listening to this lesson. And it's a kind of an extension of prior webinars that was done on FXStreet. If you recall, a few weeks ago, we did one on risk in foreign exchange trading. And what you have to do as a trader is be able to define your risk. If you can define your risk, you're able to control things like fear. You're able to know when you're wrong in the trade. And if you can do that, you're going to be better off as a trader. But there are different ways that you can define your risk. And I use certain tools, and one of them is the moving averages. But before we get started, I want to ask you this question. What do you see? And you don't see anything just yet. I'm going to put up a slide in just a second, but I want you to look at this and see, what do you see in this? And this is a piece of modern art that I found online by an artist named Barnett Newman, and it's called Vir Heroicus Sublimis, and that's Latin for man, heroic, and sublime. Now, what it means to me in words is difficult enough, but looking at it from a artist's perspective, what do you see in that picture is debatable, I think, out there. For me, it looks like a big red canvas, and I think this measures 18 feet long. And it has a few lines. It looks like a sweater that I actually had at one point in my life. It had some nice lines going across. But it is a piece of art. And some people out there would look at this piece of art and say that this says something to them. And maybe it's on the wall that it sits. Maybe it's within the decoration of the room. Maybe you can look at this. It's hard to visualize in person by looking at this picture what it's saying to you. What kind of story is it telling? I'm going to put up a more famous portrait or piece of art, of course, of Da Vinci's Mona Lisa, and there is books written about this portrait. Where is she looking? Is she looking at you? Is she looking away from you? What does the smile say about her? Is she young? Is she old? There's a lot of ambiguity in this picture that makes you really look at it in a different, it could be totally different ways from one person to the next, can it? Her position of her hands. Is she attractive? Is she not attractive? What about the background? What about the colors? What about her hands or fingers? Everything about it is really intriguing, and different people can see different things from that picture. And so I use this as a transition into my lesson today, because I like to bring things together, not only in the trading world, but also in the outside world that we all live in our lives, and in things like art. And trading also requires seeing things differently sometimes. We may all look at a chart or an indicator and think that it means this or it means that, when in my mind, I'm set in how I look at a thing like a moving average, but it may not be the same thing that another trader may be looking at it as well. So I'm going to ask another question here before I get started, and this is you don't have to answer this, of course, just answer in your mind, but is moving averages a leading indicator, a lagging indicator, or a coincident indicator? So a leading indicator is something that's going to lead the market to the upside or to the downside. A lagging indicator, an indicator that kicks in after a delay, or a coincident indicator, something that moves with the market at the same time. And I think if you look in the textbooks and if you queried online moving averages, the answer would be that moving averages are a lagging indicator. You look at a moving average and it starts to move after the price has either bottomed or price has topped out. So it'll start to move from being downward sloping to being upward sloping. And I can't argue with that. I can't argue with the fact that a moving average could be considered in textbooks, in your mind, as a lagging indicator, something that's going to tell you after the fact what the market is doing. But for me, I look at the Mona Lisa and see something, and I look at moving averages and I see moving averages as actually a leading indicator. And I hope to be able to show you why and how in today's lesson or today's look at the market. So it may come as a shock to some of you, but I actually look at it, the leading indicator, or look at the moving average as something that's going to tell me the bias or the direction, the trade direction, and the expectations for the price going forward. So it actually gives me clues that will tell me that the market is about to move higher, or the market is about to move lower, or I expect that the price to do something when it moves through a moving average. So in that respect, when I look at a moving average, I don't see it as a lagging indicator, something that's going to tell me, to predict what already happened. I look at it as something that's going to tell me what's going to happen. What is the price going to do now? What is the price going to? How is that market going to move? And I can make trade decisions off of that right now. So in fact, it's more of a leading indicator to me and a coincident indicator, because it tells me what my trade should be right now. And so it's outside of the textbook, but it's something that I hope to be able to convince you through charts and through my analysis here today that I consider it a leading indicator. So of course, some simple rules as far as moving averages is that for me, if the price is greater than the moving average, that is, if the current price is above the moving average, that gives you a bullish bias. So if the market moves from below the moving average to above the moving average, guess what? You just change your bias from being below it, bearish, to being above it, bullish. So that in itself says go long the market, okay? And it's saying that the market should go higher from here. Now, if the price is below the moving average, that is, it moves from above the moving average to below the moving average, it says that the bias is bearish. And of course, that's at the right at the moving average line when the market moves above and below the moving average line. There are other times when the market is away from that moving average. During those times, I use other tools within my trading. So I want you to all realize that I don't look at the market in a vacuum using just moving averages. I look at it using other tools, and there's only two others that I use, and I hope to use not hope, but I will go through those different tools in future webinars that I give on FXStreet, and those tools would be things like trend lines and things like Fibonacci retracements. Those are the other two tools that I use. But we're just going to focus mostly on the moving averages. I use two moving averages in my analysis. Before we get to the charts, I want to tell you what they are, and the first one is a 100-bar moving average. I consider that my trigger. That's going to tell me if the market, if I should go long or I should go short, or what my bias should be in the market looking at a specific chart. And again, we'll get to those in just a second. So it's where an action is going to take place in my trading, or I have an option to have an action take place. Okay, I don't take all the signals that a moving average may give you, but it would definitely be a trigger, is something that's going to tell me which way my direction should be. Should it be bullish or should it be bearish? And the second moving average I use is a 200 bar moving average, and that I consider my confirming moving average. That gives me confidence in the directional bias of the move. So if the price moves above the 100 bar moving average from below the 100 bar moving average, I want to look to go long the market. And if the market moves above the 200 bar moving average subsequently after that move above the 100 bar moving average, I feel more confident in that the market has reached a target. It's reached another level that gives me additional confidence in the trend, in that move, in the direction. In the example that I just explained, from a bullish direction. If the market moves above the 100, it's giving a bullish bias. It moves above the 200, it's confirming that bullish move. And you'd expect that the market should do something on the breaks of those things. In fact, I consider a move above or below the 100 bar moving average an event, something that's going to trigger an event, a movement in the market. Something should happen when the market moves above or below a 100 bar moving average. And a move to the 200 bar moving average should give you confidence. And note the word should, okay? If you use a moving average that the market is watching, and I consider both of these moving averages to be moving averages that the market watches, you should expect to see not only you reacting to that move, but also see the rest of the market reacting to that move above or below the moving average. And so it should happen. I have, for those people who listen to me, for those people who have attend up my webinars or go to our website at forex.fxdd.com, or perhaps even read it on FXStreet when I post on their site as well. I will use these moving averages as, or I have a rule that I apply, and it's called the if-should rule. And the if-should rule says this: if the market should go from below the moving average to above the moving average, and you can have any other rule in there, but if the market breaks above the 100 bar moving average, the price should go higher. If it doesn't, that is, if it doesn't stay above that 100 bar moving average, you don't get that event, you don't get that movement in the market, you should get out. You should get out. Why? Because the market's not doing what it should do. That's what should happen. And I find that these two moving averages, they often lead to an event happening, a movement, a move away, a reflection, a deflection, something that's going to cause the price not to trade around that moving average, but move away from it. And you want to see that further momentum in the direction of that move. So let's go through some examples in the market. I'm going to turn off my camera here for a second, and I'm going to bring it back up in some charts here. So just bear with me for a second. And by the way, if there's any questions, you can just send them in. But what we should see here is that this is the euro versus US dollar. Let's go to the 5-minute chart just here for a second. And what we saw here as an example is that the market was staying. This is a 5-minute chart of the euro, and I look at 3 different time periods in my chart. But let's go back to the beginning of the day. This is the beginning of the weekend day, and you can see on Friday what happened. This is the 100 bar moving average, and on Sunday night when the market opened up, it actually gapped above the 100 bar moving average. Ironically, or maybe not ironically, the market closed right at the 100 bar moving average on the 5-minute chart. And if I can go back in time, you can see that for most of the day, the market was below that 100 bar moving average, trending to the downside. We had a corrective move that got with it close to the moving average here. This high came in, looks like around 137.65, and the moving average was at 137.70. So there's only 5 pips away from that moving average. And what does that signal to traders? Well, the trend is down. The market corrects. The market corrects up to the moving average line. And this allows a trader to define his risk. From our last show, risk, risk, risk. If you can define your risk, and if the price stays below that moving average line, guess what? That you have the opportunity for the market to move in your direction. If it doesn't, you get out and you lose 10 pips, maybe 12 pips or something like that. but we were looking at the euro here, and I was talking about this area right here, and this is Friday's trade when the market was trending to the downside. We had this corrective move, and the market was able to trade, or market traders were able to trade against this 100-bar moving average. That's always the blue line in my chart, and the market moved away from that level. Why? Because traders could define their risk. The risk is this small amount. If the market moved above the 100-bar moving average, they would get out. If the market stayed below, you stay in the trade, and the market moves down to, it doesn't make it to new lows. In fact, it makes it to this low right here before the market finds some bottoms. So at the very least, a trader could have sold in this area with this amount of risk, and made the difference between that period, this area here when the market on Sunday night, well, it actually closed on Friday afternoon right at that level, so you probably would have gotten out when the market failed to get below this level. It's probably giving you a clue that the market had already run its course and we're moving into the Friday close. So what happens today? The market opens up and gaps higher initially on the opening, and then we come down to the 100-bar moving average. This is typical. The market typically finds support or resistance against that level. It's kind of a point of reflection of deflection, and then the market moves higher. But when it breaks through this line right here, it is a trigger. It says to me, hey, I expect the price to go down. I expect the moving average to be a leading indicator with the price below it to lead the market to the downside. As long as the price is below that, it should go lower. And that's exactly what it did. It made it through its low here, and then started its move back up to the upside. So from a trader's perspective, from someone who's looking to execute transactions in the market, this failure above on the opening and a move down to test the 100 and a break through that level was a clue. It was a clue that said, hey, expect the market to go down. The market should go down if it doesn't get out. But that is trading. It's about expecting something to happen. If it happens, you're a winner. Now you have to look for next targets along the way. Look for levels to profit, and if you're right, you should be able to at least make some sort of profit on this trade. Now, from the strictest standpoint, where would you get out of the trade? You would get out when the price moves back above the 100-bar moving average. Why? The bias turns from bearish to positive, but of course you as a trader are a little bit more probably a little bit more active, probably a little more proactive in your trading, and you might think that, well, once the market bottoms and the market moves back above that 100-bar moving average, the bias turns back to a little bit more to the upside. It's failing down here. There's an opportunity to probably buy your position back and take a little profit in your account to start off the week on that first move to the downside and the failure and the move back up to the upside. But even if you got out at this point right here, you're still profitable in the trade. And then what happens from that? This green line is our 200-bar moving average, and this the market moves up toward the green line and then can't get above that level. This is a situation that I call trading in between the goalposts. Okay, this is not something that you're going to find necessarily in any books until next month when my book comes out at the beginning of April, when I start talking about attacking trends and also this idea of trading in between the goalposts. And I define the goalpost as my 100 and 200-bar moving average. There's a little bit of a gap in between those two moving averages. It says that as a result, what you get is these buyers at dips, maybe buyers in this area coming up, and they're looking for levels to take profit. And when it breaks above the 100, they're going to use that 200-bar moving average as an intraday level to take profit and see what happens. If the market cannot get through that 200 and it moves back below the 100, they made a nice profit on the deal. They used this level as a level to define their risk. It did not confirm the move to the upside through the 200. But if it did, like at this point right here, they have an opportunity to get back in the market. And this is why markets go up and they correct and they go up and they correct, because they reach certain target areas. This level right here is a target area. Why? Because it was this high right here on Friday afternoon. And so it becomes a level of resistance, and that's what markets do. They move from level to level. But what we can see in this chart here is that it had resistance against the 200, but it had to get through the 100. When it didn't, it gave the A-OK to buy. So it was a leading indicator staying above this 100-bar moving average that the bias was back to the upside. The failure at the 200 was one thing. The inability to get through the 100 was another thing. It gave an indication that, hey, it's okay to buy the market, expect the market to move higher, and the moving average led the market to higher levels. The inability to move below that 100-bar moving average said, you can go to the upside market. Go ahead. Try it. Let's see how far we can get. And that's how we see the market progress for the rest of the day, or for the rest of the London session, really. We moved all the way up to the top until we find some resistance. And here, in the last, hour or so, the market has moved back below the 100-bar moving average on the 5-minute chart. And as soon as we went below that key support, that level, through below that level, we've seen selling pressure come back into the market. And what do? We corrected up because we came down to a support area, some area, and you have to go back in time, but you can look back in time, and this is a level that I looked at this morning, that I outlined this morning in my commentary, that this is going to be a support line. Why? Because the market spiked up to this level and spiked down. Next time it came up to that level, it came back down. It came up to this level, came down, came up to this level, came down, and then moved up and used that level of support. Well, that's what I call a remembered line. That's why I have this line in here. This is the market moved down to that level. To mention, we have other tools like the 38.2% retracement. So what happens is the reverse of down here. It moves to the 100. The 200 is way down here, so it looks for other areas of support. We also have the trend line here. And the market, what has the market done? It's come back, tested the 100, and moved back to the downside. So right now we're kind of in between our own little goalposts here. In fact, the goalposts are much wider here, but we're finding other levels of support on the downside, but we're using the 100-bar moving average as resistance on the top side. And this is what trading's about. It's about going from level to level, about using the tools and the things like moving averages as levels to lean against. So this is nice and clean, and you can see it. You can see how the market found support against 100, moved up, broke through the level, came back higher, came back, and now the market has a decision to make. So what would I think going forward in this euro versus US dollar? Well, guess what? If we break through this trend line, if we stay below this 100-bar moving average, we should see further selling pressure with the 38.2 and the 100 and the 200-bar moving average being the next target. I have a question here. What time frame you use for what moving average? So the time frame in the chart. So this is a 5-minute chart, but I can also look at the hourly chart as well, and I use the same moving averages in this chart as well, Adrian. So the blue line is a 100-bar moving average. The green line is a 200-bar moving average. And these are simple moving averages. I'll bring that up here. 100 period, shift, 0, simple. It's on the close. You always use blue, and I always use green for the 200-bar moving average. I can click on this 200-bar moving average, look up the properties, and you can see it's 200. It's simple, and it's on the close, and I color that green, so that's always the green. So now you bringing that, and I also use a daily chart as well, and I use the same moving averages. So look at this chart right here and start to analyze this from a perspective of a moving average. And what we could see here is that we had support against the 100-bar moving average at this point, a few weeks ago, where the market was moving above and below this 100-bar moving average for a period of 4 or so days here. The market originally moved below the moving average. We saw a extension to the downside. We found support against the 38.2. It couldn't get back through that level, so it moved back higher on the next day. We opened up just above it and moved below, and we extended to the downside. So imagine, this bar right here is just a piece of a daily chart, but you can imagine that, okay, the market, and if you look at the 5-minute chart or the hourly chart, you can see that the market opened higher, broke through the 100, and moved down through that level. On the next day, what did we do? We closed somewhere in the middle of the range. So it was a kind of a disappointment in this move to the downside. This is still a significant move to the downside on an intraday basis. So you as a trader can use that as a tool, even for your intraday trading. Although it's a daily chart, you can get ideas for your direction for the intraday move. So what I like to do, Adrian and other listeners out there, is to not necessarily look at the each of these charts, the 5-minute, the hourly, and the daily, as a short-term, medium-term, or longer-term, but I'm instead looking for what are the key levels that are on the daily chart, and I consider the 100-bar moving average on all charts to be an important level. And you can see that in this daily chart that it runs true, just like it did on the 5-minute chart. And so the market could not get above the 100 for long, and it came back down. It could not get above the 100 For long, it came down, back down. And the next day, what do? We broke above the 100 and closed above that 100-bar moving average. And we had higher lows here. We found more support against 38.2. And not surprisingly, it turned the tide more to the upside at this point. And you get a nice rally to the upside. So even when the market is kind of non-trending, you can get clues from these moving averages that allow you to perhaps trade more on an intraday basis in this market. And so they become very important. You get the sharp move to the upside, and when we get the sharp move to the downside, it breaks through the 100. What should the market do? It should head down toward the 38.2 at this point. Does it? No. And that's why we get this sharp move to the upside. So you can see that this area right here becomes a point that's, you really have to pay attention, a level where you have to decide, hey, I got to get in this or I got to get out of this trade. Either this is going to work or it's not. But I want to see it. I want to. If it breaks the 100, I want to see it move down. I want to see that direction. And if it doesn't, I want to get out. So does that limit your risk? Of course, it limits your risk. Does it mean that you're going to be right every time? No, there is no perfect technical tool out there, no matter what anyone says. But what it does is it tells you that something should happen here. If that something happens and you're long, you buy on the failure down here and you buy above at this point right here. By the end of the day, you're up over 100 or so pips to the upside back again, and that's what you have to build your trades on, and that leads to further levels to the upside here. So, and now the 100-bar moving average is not close to the current price, so you're not really paying attention to the daily chart at this point. But at this area right here, you start to really pay attention to what's happening with the 100-bar moving average. And the same goes true for the hourly chart here in this in the euro versus US dollar. If you look at the move to the upside, had a rally up from Wednesday, or this is Tuesday, Wednesday, Thursday into Friday. We ran into trend line resistance up here at the top here, and the market found some sellers, and the market started to move to the downside. Where do we go on Friday? On the move to the initial low, we went right down to the 100-hour moving average. The market found buyers against that 100-hour moving average. We moved higher into the close, and the market closed what we saw off the 5-minute chart right against the 100-bar moving average on the 5-minute chart. So even on the hourly chart, it was predictable what you could expect in the market against that level, and that's what's going to give you the ability to define your risk, to be able to keep your risk to a minimum and potentially have trading profits within your trading account. So what happens here today? The market moves back below the 100-bar. It comes initially to the 100-hour moving average there. I'm going to zoom in here a little bit. Finds a little support, breaks through the 100, and we get the sharp move to the downside that takes the price down to our lows even below the 38.2. But what does the market do? It fails. It starts moving above the 100-bar moving average, and what does that lead to? It leads to the sharp rally. Notice how on the bar above the 100-hour moving average, the market comes down and tests the 100-hour moving average. Is that a level that the market traders are going to be paying attention to? Those smart traders who are going to be watching and seeing where there is support, where there might be intraday support or resistance, where you can define the market, where you can look for the potential for a move to the upside if you have a bullish bias. It's right here, folks. Your risk is limited. The potential for the gain is, or you don't know what the gain will be. In fact, you're probably looking to take out the high. If it takes out the high, you're going to be looking for the underside of these trend lines. If it breaks through that, you're going to be looking for other areas. But you start to find these levels and you build the trade. I'm always reminded of what Gartman, I can't remember his first name now, Gartman, from the Gartman letter on CNBC, what he said one time when he was talking about gold. He was saying he was long gold from lower levels, blah, blah, blah. But they asked him, what made you decide to go long? And he said, well, it was first a trade. It was first a trade, and then it became an investment as the fundamental pieces started to come together. But everything in currency trade, Dennis Gartman, there you go. Dennis Gartman, everything in currency trading, from my perspective, from my experience, is always about a trade. It's about selling the market because here, at this point right here, expecting the market go down, and when it doesn't go down, when the trade doesn't do what it should do, it's getting out and maybe even thinking when the market moves higher and comes lower or moves comes down, tests the 100-bar moving average, that you should get long and get long the market and then ride that to the upside. That's a trade that then leads into more of a longer-term trend moving, and you can see how the market would have really benefited to the upside here. So, looking at the price action, since we just went through the level here on the, or since we looked at the 5-minute chart, what the euro do? Came up, tested the 100-bar moving averages here, moved higher, broke through the 100, came down to our next support level against the old highs, moved back, tested the 100-bar moving average, and floated its way back to the downside. Guess what we're approaching now? The 200-bar moving average. Do I expect to see support here? Yes. Why? Because we have the 200-bar moving average. We have the 50% retracement of the day's trading range. Is that can you define risk against that level? Can someone who is short from above perhaps look to take profit against that level? Yes. Why? Because risk is lower. If the price moves below the 50% retracement, guess what? Go short, look for the next target along the way, look for the market to continue in the direction, look for confirmation through that 200-bar moving average that's going to give you confidence to the downside. So I have a question here. Why do you favor the 100 simple average, hundreds instead of other simple moving averages? 100 simple moving averages instead of other simple moving averages. That's a great question, Adrian. And I don't want to stop other people from using other moving averages, but what I find, Adrian, is, and there are other moving averages that the market will watch, but what in my mind, as a trader, what you have to do is not have too many. Okay, what I will focus on is just two. One is a trigger. One is a confirming. Needless to say, there are plenty more that you can have in there, including 55-bar moving average, which is a Fibonacci level. Some people like 34. Some people like 18. Some people have different moving averages on their shorter-term chart, their medium-term chart, their longer-term chart. Me, I want to keep it simple. I think simple is the way to go in foreign exchange. So when I started to look at moving averages way back when, and I've used these same moving averages, I don't move away from them. I started to think in terms, okay, what is the market watch? And quite frankly, part of the answer came from watching business television, like CNBC and Bloomberg. And if you listen to those channels enough, what you'll notice is that 99.9% is fundamental analysis. They'll talk about why this, why that. They'll have Fed's Bullard on TV, and he'll talk about all the fundamentals. He's not going to talk about a technical chart. But what we've shown here today is, and what I profess to at least retail traders out there, because retail traders, unfortunately, you are a slave to the market. You cannot tell the market what to do. So what you have to do is try to listen to what the market has to say. And the listening comes at these points. And this is why I look at it as a leading indicator, because you're listening to that the market rejected this low. It moved above this high. It moved above the 100-bar moving average, failed at this point, found support here. Listen to what this has to say. Jump on it and look for the break to the 200. Look for the ability to stay above the 200. Look for the move to the, look for the correction to test and move back to the upside. And you'll find that if you listen to what the market has to say, you will be able to follow the rhythm of it and use this tool as not a lagging indicator that says, oh, well, the moving average hasn't moved down yet, but as a leading indicator. The price broke through the 100-bar moving average. I'm looking for it to move lower. And so I started to look at the pace of the market, and I found that 100 bars on a 5-minute chart really has a nice pace to it. It's not too fast. It's not too quick. It's not too slow. It's kind of just right. You can see here that the market, when the market trends and then it consolidates, it's enough time to allow that 100-bar moving average to catch up to the market. And I like that. I like the pace of it, that it's not going to get me out too soon. And, the market moves at a rhythm. You can see here that the market consolidated, came down, consolidated. And by the time it got to this point right here, the market had the decision to make. Does it want to go lower or does it want to go higher? Sometimes it'll bounce off this and move to new highs. Sometimes it'll break through that and move lower. But it gives you the clues. It gives you what you should be looking at in your trading. And that's why I use these two moving averages. And I think on the hourly chart, it's a slower pace, but it gives you these opportunities. Like today, we had a test of the 100. Yesterday, the market came down to the 100. The day before, it moved away from it, and on this day, it moved above. So a lot of times, you'd be surprised the market is going to touch these areas. And if it's trending, you pay attention more to the 5-minute chart. So I hope that helped you answer your question. Have you tested this also on commodities? I look at it on gold, and look at the 100-bar moving average on gold, and you can find some clues here. Here's market on the gold to see how the 100 and 200 bar converge. This is what I call Riese crowd when two moving averages converge. Gold is obviously more volatile, but it'll come down, and if you get this type of bounce off of two moving averages like this is significant, folks. Okay, if you see that boom bounce off of that, believe it. Okay, believe that something happened. Yeah, it goes through here. It goes through here. And you don't really know, but if you see this bounce off of here, think about getting long, risking that much going through that level. When it breaks through the 100 here, what do? We come down to 200, it corrects up, and it breaks through that 200, confirming the move. So you'll see a number of different times in the market. Of course, it gets more volatile here. This is unsustainable, and this leads to the upside. That's why I use other tools. I'll make this a little bigger here. Other tools like Fibonacci's in these charts, and so you'll get an idea of what the level of retracements are here as well. It doesn't necessarily, it's kind of this is not normal type situation, but you can see here the market gaps through the 100 here, comes back down, tests the 100, moves back higher, comes back to the 200, bounces off of that level. So they're all what I call borderline levels. These levels that you can buy against, levels that you can use to define your risk. And sometimes you have nice trending markets. Some you have nice quiet markets. This is what you consider a normal market. This isn't an abnormal market, but oftentimes you'll see the market move up to the high and come right back down, right to the 100, and they'll find the profit-taking buyers there. Two reasons to buy here: 50% retracement, and the 100-bar moving average comes in the same area. So when the euro US dollar pulled back to the 100 moving average, why do you not enter the first time it pulled back twice? So which 100 off the hourly chart or off the hourly or the 5-minute chart? Right here. That's SW, hourly. Okay, let's look at the hourly. And when the euro pulled back, why did you not enter? When the euro pulled back to the 100 moving average, why did you not enter the first time? So at this point right here, or right here. Okay, which one? This one, say yes, or this one, say one or two. So this is 1, this is 2. So why didn't I buy 1 here? So why didn't you would buy here if move back to why did you not enter the first time? So you could have entered here at this point or this point right here, and your stop would have been below if the market moved below the 100-bar moving average if you bought it, especially on a sharp move to the downside here, and we're approaching the 38.2. There's a lot of reasons to buy here. I always try to get as close to the area to buy, and I'm gonna zoom out here. I'm gonna show you what the significance. So we have this move to the upside, nice trend move to the upside. We define a top here, and the market starts to come down. We have these other trend lines in here that I have coming in here. But I want to be as patient as I can and buy against this 100 and the 38.2. I'm just risk averse. I try to get as little risk as possible. But anyone could buy at this level right here, and you're risking a break below the 100 and probably a break below the 38.2 on this trade if you're buy against that. And that's a good trade. But you have to live through, holding your stomach or whatever when the market moves back and it goes even lower here. You're fearing the risk to the downside. But both of these levels are good levels to buy against on any sort of move to the downside. And or if you're short, if you looked at this high here and said, oh well, 1, 2, 3 hourly bars we're at the high, so what is my risk of selling against this level? And I have this other trend line in here. But, there's a good reason to sell against this level as well, a triple high from an hourly chart perspective. And so you could be short here. You're definitely thinking about buying and taking profit at this point right here, especially after 1, 2, 3, 4, 5, 6 hours to the downside with a nice move from 138.37 to 137.17. Why not buy against the 100-hour moving average? Market hadn't been, was above the 100-hour moving average going back to this date, February 22nd. We're on February 20, and it's Friday. You buy against the 100-hour moving average at that point. So I would do all this trades. Any trade against these levels is good. Now I mentioned that at this point right here, where the market breaks through this level, what do you expect to happen? You expect it to go lower, right? And it should go lower. And it does. And when it moves to the 38.2, it goes even lower. But then you have to start defining, okay, what's the next level it has to get through? And this becomes a level that it has to get through. This level becomes a level that it has to get through. And we find the buyers against that. So this is that if-should rule. If the market breaks the 100-hour moving average, it should go lower. If it doesn't, get out. And so you're selling here. Market goes to the 38. Okay, it goes through here. You may start to get a little bit weary when the market moves back above the 38.2 here. And, so that, this is probably not going to work out for me. So you get out. And that's, but you risk a little to potentially make a lot. And if you're smart enough and you're quick enough and you're observant, you see the failure down here. And you see the test right here, and the market starts to move high. Now you're thinking in terms of now you've got another risk-defined trade here against the 100-hour moving average. And I like to say, folks, that good traders make their own luck. And the reason why good traders make their own luck is because they trade with risk in mind. They trade against where they can define their risk, and their risk is small. And if they could do that, if they can look at the clues in the market here, they get lucky. And people would say, oh, he's so lucky he got this, whole move to the upside and the market moved up here. But imagine yourself getting long here at this level with your stop right here. You're in control of your position. And it happens. You get lucky because something comes out or whatever. The market moves higher. Even with inflation coming out weaker in Europe today than the expectations, the euro continues to go higher. So he's so lucky. How did he know? Well, he was only lucky because he bought against the 100. He saw the failure down here and he bought against the 100-hour moving average and he risked this amount and the market went his way. And that's what you have to try to do, is stop thinking in terms of what you think should happen, and instead listen to what the market is saying. Use the moving average as your leading indicator to which way the market should go. It doesn't necessarily mean it's going to go there. Just use it as your tool, and you'll find yourself might get lucky every once in a while. Good luck, not blind luck. Good luck. What's your take on the moving average crossover, Greg? I mean, how do you interpret them and how you trade them when occurred? That's a great question, Mike. And there are two ways you can look at crossovers. One is this way. You see the 100 crossed over the 200 at this point. That might signal people to, well, you should go long the market. Me, I don't look at this one as a signal. I don't even pay attention to this crossover of the 100 over 200 at this point. Why? Because the price is way up here. The price has already, this is where moving averages are a lagging indicator in this case. The price is way up here. So what is my stop? Well, when it crosses back below it, I mean, it ends up working out. But what do you do? You go long at this point right here, and the market comes all the way down here. It didn't cross over yet, and it's still not crossed over. So you're long, but you had to live through this whole thing. So this means nothing to me, Mike. This crossover where the price and the two moving averages are away from each other means nothing to me. Now let's go I'm going to go to where it matters to me. And this is a situation where it matters to me. I call this three's a crowd. Two's company, three is a crowd. Remember that saying I don't know, just in life, if you're on a date, you don't want your buddy along with you. Two's company, three's a crowd, because you want to be with your girl, right? So here we have the price in a narrow trading range. Moving averages are moving sideways, and the price is the two moving averages are converged, and they cross over at this point with the price. That is three is a crowd. That says to me that the market is in equilibrium. And what happens when markets become in equilibrium with narrow trading ranges, it says we have to move away from this. And whether it goes higher or lower, you don't know. But what you see here is this is a very narrow trading range. The market has defined its range over 8, 9 hours in this period right here, and then you get a break. And this means something to me. So when two moving averages, 100 and 200 moving average, cross over with the price, that is something you pay attention to. But the other thing that you have to, if the market is just moving up and down, a very volatile thing, and it's 100 and 200 converge, that's less predictable than something like this, where the market is a very narrow trading range. Here's a question from Menno. You risk not in percentage of your account? Yes, I risk in percentage of the account, and I suggest that everyone risks in percentage of their account. You shouldn't risk more than 3% of your trading account, but you can risk less than that. You don't have to risk 3%. You can just risk a small amount. Do not ever. Or what I suggest is don't go over 3%. It's just a way that you're going to. A lot of times when people risk over that amount, they start to rationalize, well, the market's going to rebound and stuff. You just get yourself in trouble. So the amount that you do at these levels right here, are dependent. It's also dependent upon what you think the potential is for the market. And where you are in the trading day, and all sorts of things that go into consideration. Obviously, the market was trending to the upside here, so me personally, I wouldn't necessarily do a 3% or have a big position on this move, but I would consider taking profit. I'd be considered selling, perhaps selling a little bit at that point right here. So it all depends. Do you consider the slope of the moving averages? I mean, there are indicators out there that measure just this. I will. Yes. When the slope starts to go sideways, that's an indication for me in a moving average that the market is in equilibrium. It's due for a move. So think about it. 100 bars on 5-minute chart, that's 500 minutes. So if you have 500 minutes and the moving average is going sideways after moving to the downside, guess what? The market is more in equilibrium here. So you're looking for the market to move in a direction, either to the upside or the downside. Now you start to look at the price, and you start to look at the moving average, and you start to look for what opportunity exists. Does it mean that we're going to get this rally up from this level to this level? You don't know. But what you do know is that we should get, again, that if should rule, we should get a movement to the upside. Now, by the same token, if the moving average is moving, here it is moving at a nice pace to the upside, and the moving average is still going to the upside here, or the slope is still positive, so that would suggest that the bias is still bullish. And you could say that the bias is still bullish here in the euro versus US dollar. Why? Because we're above the 50% retracement. We're above the 200-bar moving average, and this just may be a correction to the downside here. If this market finds support here and moves back above the 38.2% retracement, I would look for a rotation back to the upside here. That's that's how I'd look at it. So so slope matters. What I like is no slope. That says to me, something's about to happen here. Look at the sterling versus US dollar. Or sterling versus yen. Market moves below the 100-bar moving average, comes to the 200-bar moving average, moves a little bit below it. Guess what? Can't confirm the downside, comes back up. What do? We go up to the 100. This is in between the goalposts. Market moves below the 200, moves down to another new low here. We don't have Fibonacci in here, but fails up here, comes down. Obviously, sterling versus U.S. dollar is going to be a little bit more, or sterling yen is going to be more volatile. We come up to the 100-bar moving average. Can't get above, can't muster any movement above that level, and starts its move to the downside. You may, because of this volatility up and down that you see here, you may be more patient here and actually use the 200, since they're coming together here, use a 200-bar moving average as your trigger in this case, because you're unsure. We're seeing that, So, but since they're so close here, they become almost one at this point, and you start, the market starts to move down, and again, you just ride it. We didn't even talk about profit targets or how would you manage your gain on this trade, but you can imagine that if you have good trade location, this gets into the point of, okay, well, you define your risk, keep your risk to a minimum. You end up getting good trade location. You're able to manage your profit instead of managing your loss. So you start to use trailing stops. You start to put Fibonacci's on things like this to here. You see that this move to imagine that you're in this position, you have good trade location. I'm just going to hold it here, and you say, well, if it gets above the 50% retracement point, I'm going to get out of this trade. There we go. If we get above the 50% retracement, I'm going to get out. But in this case, it just goes to 38.2 and then comes back down. You start managing your profit. Now you can see here we moved above the 100 here. We're starting to move back higher in that currency pair. Do you also believe that there's a moving average which shows a trend more clearly? I mean, for me, the 21 EMA and the 34 EMA often give an indication of the current trend and when this is about to reverse. What is that the 21 on what one chart period? Is that on the hourly chart, or is it on what chart period? And the other thing that you have to remember, Mike, is that on the 5-minute mostly, okay, is that I like the pace of the 100 on the 5-minute, but you also have to remember that I like the moving average, but I also like this line right here. I get clues from other tools that I use. Trend lines, and a horizontal line is a trend line, okay? It's a trend line that doesn't have a slope, okay? So a horizontal line is a trend line. So I get clues from this. 1, 2, 3, 4, 5, 6, within 5 or 6 pips. So you may be looking at a 21 EMA, and that may be showing a turn at this level right here. I am looking at, I don't want to duplicate too many things, okay? I want to keep the integrity of each of the clues that I use and use them without having too many things conflicting, okay? And I just like the pace of the 100, and I also like the ability to draw my line and to kind of say, well, this is a clear signal. All these times a break above that fails, a correction down, and I move back up to that same level, that's a clue, all right? And you may be saying, oh, well, the 21 EMA and the 34 EMA is there. And then I'll say, well, I'll sell against this level right here, and guess what? I need to get through the 100-bar moving average, so this becomes a target for me on the downside. And I don't want a lot of moving averages on my charts as well. I just want 2. I want to keep it simple. You have too many things on, and you're finished. So I got to finish up. Thank you very much, Vicky. Thank you very much, Adina. Thank you, people at FXStreet, and thank you for all you people coming in for the webinar here today. If you want, I don't know, I think, is there going to be a rebroadcast, or is this tape? Anyway, I'm out of here. Take care, guys.